Welcome back, everybody, to another episode from the WIP Report. I will say I've noticed quite a few views on the what is the point of construction WIP, so I thought it'd be beneficial to do a deeper dive into how the WIP works. What we have in front of us is the WIP Report, which you can download on the website, www.thewipreport.com. I'll leave the link in the description box. I inputted information about a made-up contract in columns C and D. We have a total contract price of $100,000, what's going to be billed out in total once the project is going to be completed. Total costs of $70,000, that's cost from beginning to completion. The same for every job, assuming this is the same contract. But what varies is the activity. The cost to date and billings to date are different for each scenario. So let's get into these examples. Scenario 1, you have $20,000 cost to date, $25,000 billed to date. Now, if you calculate gross profit percentage just off of the billings and costs, you're at 20% gross profit. That I'll show you right here is your $25,000 minus $20,000 divided by the billings to date, 20%. Notice one thing. You estimate that the whole job will have 30% gross profit, but you're billing at a rate of 20% gross profit. Here's where underbillings come into play. When you have estimated gross profit higher than your actual gross profit calculated on the activity, you have underbillings. Underbillings are an addition to your billed amount. So if you come here, revenues earned is just your billings to date plus your underbillings. That is $28,571, right? Calculate the gross profit now off of the revenues earned. And here, this column J, this 8571 is your gross profit. You calculate it now and you're at 30%. Boom. Now you agree. So that's where we're getting this idea of underbillings from. So let's move on to the second example. Same contract amount, total estimated cost. This time $20,000 cost, but $15,000 in billings to date. Just based off of that activity, as we looked at the example above, we're at negative 33% gross profit. Okay, 15,000 minus 20, that's a negative, divided by the 15 again, that's negative 33% gross profit. We can't have that. We expect 30% gross profit, and we're going to recognize 30% gross profit. So underbillings, again, in this case, because clearly positive 30% is greater than negative 33%. You have your billings to date plus your underbillings is $28,571. Calculate gross profit based off of the revenues earned and the cost to date. You're at 30%, so you match. Same idea. You'll see here that you billed more in the previous example. You had 5,000 more billings than you had cost, but yet you were still underbilled. Okay, and that's all based off of your costs incurred and your estimated gross profit. Just because you billed ahead, so to speak, doesn't mean you have overbillings. You can see here clearly as the first example, 5,000 more billings, but you still have an underbilling because the rate you were billing at was 20% gross profit when you should have been 30%. Okay, so let's go on to the third example. Same contract information except zero cost to date, but billings of $25,000. I know it's an unlikely scenario, but to demonstrate this point, no costs incurred, but you still billed an amount. Now, you recognize revenue based off of costs incurred as a percentage of total estimated cost. So zero cost to date divided by estimated cost, there's nothing there. you are not entitled to recognize revenue. 0% complete. Everything you build is erased through overbillings. You have done nothing to earn that $25,000. As you can see here, revenues earned is 0. You take your bill to date, and instead of adding it like you did under billings, you're subtracting your billings by the overbillings, which leaves you 0. So it doesn't matter revenue-wise how much you build, that's all being erased. Now, cash flows, yes, that'll put you at an advantage. If you've collected it on time, you're ready to buy the materials or pay payroll. It's an unlikely scenario, but I hope you get the picture of how that's working. Let's move on to the fourth example, where we have more costs, $35,000. We have billings to date of $30,000. Again, we have less billings to date than we do have costs. So we're at a loss of 17%. Again, we're expecting 30% gross profit. So here we go with the balancing act here. We have 30,000 billed. We add our underbillings, and we're at 50,000 revenue earned, which gives us 15,000 in gross profit, which is 30%. So that's the idea, is just maintaining that estimated gross profit throughout the life of the job. Last but not least, this $35,000 cost to date in this last example, $72,000 billed to date, 51% gross profit just based off of the activity. 51%. Now, for the first time, not first time, we had it up here too, but in this example, we have 51% rate based off of our billings to date and cost to date. That is more than what we're expecting. So overbillings comes into play to carve out that excess of 21%, brings it down. It offsets your revenue and decreases it to give you that 30% gross profit. So 72,000 in billed to date minus your 22,000 in overbillings gives us 50,000 in revenue earned, which when calculated out is 30% gross profit. That again is just the 15,000, which is revenues earned minus cost to date divided by total revenues earned. That agrees to your estimate. I hope all that made sense, and if it didn't, please feel free to reach out with questions either in the comments section or visit the website where you can access my email, send me questions, whatever it is. I hope this is all coming together. Thanks again for tuning in. I'll see you in the next lesson.